Dear viewers, and when you think of giving up, just remember how far you have come. I'm your host Muhammad Asif Jajja and you are watching my YouTube channel ETV 786. We are learning the basic concepts of accounting through this channel, and this is lesson number 18, Company Accounts. Please watch, like and share the videos and subscribe the channel. Basic concepts of company accounts. A company is a voluntary association of people who contribute money for a common purpose. A company is an artificial person and a separate legal entity. The contribution of money by people forms the capital of the company, and the contributors are its members. Hence, the capital of a company is known as share capital and the contributors as shareholders. Each country has their own rules and regulations to govern all companies or corporations and provides guidelines for them to adhere to. The legal side of the company will be further explained in business law portion. Issue of shares. The issue of shares is a process in which a company allocates new shares to the public. The company issues prospectus, receives applications, and then allocates to the public. Shares are issued either at par or a premium or a discount. If the shares of a company are issued at price more than its face value of the shares, the excess amount is called the premium. If the shares are issued at a price less than the face value of the shares, it is called as share issued at a discount. Accounting for share capital. A company cannot generate its own capital, which has to be necessarily collected from several persons. The persons who contributed the amount are the shareholders, and the amount thus collected is the share capital of the company. The capital amount collected is kept in a share capital account, which classified as number 1, authorized capital, number 2, issued capital, number 3, subscribed capital, number 4, called up capital, number 5, paid up capital, number 6, uncalled capital, and number 7, reserve capital. Review of financial statements. Company accounts are a consolidation of a company's financial activities for 1 year or an accounting period. The cash flow statement records the movement of cash in and cash out of the business through operating activities, investing activities, and financing activities. The balance sheet of a company gives an insight into the assets, liabilities, and shareholders' equity. In a profit and loss account, we can see the detail of revenues and expenses of business throughout the financial year. Types of share capital. Share capital of a company can be divided into two types. Number 1, equity share capital, and number 2, preference share capital. Number 1, equity share capital. Equity shares are shares which are not preference shares. They carry maximum risks and rewards of the business. In the case of high profits, they receive higher dividends and appreciation in the market value of the shares. While in the case of loss, there exists a higher risk of losing part or all the shares. Equity shares capital may be with the voting right or with the differential rights related to the dividend, voting or any other right. Preference share capitals. Preference shares are shares which carry preferential rights as number 1, preferential right to receive dividend. This implies that the preference share holder receive dividend at a fixed rate before equity shareholders. And number 2, preferential right to repayment of capital. On the winding up of the company, they receive the repayment of capital before paying the equity shareholders. Deemed preference share capital. The capital will be deemed to be preference share capital when it has either or both of the following rights. Number 1, in addition to the preferential right to payment of dividend, it possesses a right to participate. However, the right to participate may be fully or to be limited extent. And number 2, in addition to the preferential right to repayment of capital, it possesses a right to participate. However, the right to participate may be fully or to be limited extent. Types of share capital shown in the balance sheet. Number 1. Authorized or nominal capital. It is the amount of capital with which a company registers itself and also states the amount in the Memorandum of Association. It is the maximum amount of capital beyond which a company cannot issue shares to the public without amendment in the capital clause in the Memorandum of Association. Types of share capital shown in the balance sheet. Number 2. Issued capital. It is the amount of capital which a company offers to the public for subscription and to the vendors or promoters for consideration other than cash. In the balance sheet, under the head Issued Capital, a company needs to state the different classes of share capital, the date and the terms of the redemption or conversion of Redeemable Preference Shares. Types of share capital shown in the balance sheet. Number 3. Subscribed capital. It is the amount of capital for which the company receives the subscription from the public and make the allotment to them. It can be equal to or less than the issued capital. Types of share capital shown in the balance sheet. Number 4. Called up capital. It is the amount which the company calls from the shareholders to pay on the shares. Usually, a company does not call the full amount at once from the shareholders. Hence, the portion that the company calls is called up capital and the remaining portion is uncalled up capital. Types of share capital shown in the balance sheet. Number 5. Paid up capital. It is the amount that is paid by the shareholders. This is the amount that we include in the balance sheet total. It may be less than or equal to the paid up capital. Classification of preference shares. Number 1. Cumulative Preference Shares. These are preference shares which carry right to receive arrears of dividend before the company makes payment to equity shareholders. And number 2. Non-cumulative preference shares. These are preference shares which do not carry the right to receive arrears of dividend. Classifications of preference shares. Number 3. Participating preference shares. The Articles of Association may provide that after paying the dividend to the equity shareholders, the preference shareholders will also have a right to participate in the remaining profit. Thus, the preference shares carrying this right are participating preference shares. Classifications of preference shares. Number 4. Non-participating preference shares. These are preference shares which do not carry the right to participate in the profit remaining after paying the equity shareholders. Number 5. Convertible Preference Shares. These preference shares have a right to conversion into equity shares. Number 6. Non-convertible preference shares. These preference shares do not have a right to conversion into equity shares. Classifications of preference shares. Number 7. Redeemable Preference Shares. These preference shares are redeemable by the company at a specific time, not exceeding 20 years from the date of issue, for the repayment. Number 8. Irredeemable Preference Shares. These are not redeemable and thus the company pays the amount only at the time of the winding up of a company. Viewers, you are watching YouTube channel ETV 786 and this channel is created for business, trade and commerce students. It includes the playlist that consists of complete lessons on the basic concepts of accounting in stated sequence with multiple options. Right one may be chosen for the study and revision. Please try and comment. Please view, like and share the videos and subscribe the channel for watching the updated uploads. Bye bye.